Hello, everyone, and welcome to our K-1 Pass-Through Entity Series. I'm Dave Stauffacher, the Senior Credit Trainer with Lenders Online Training, where we help lending and credit professionals say yes to good loans. I'm joined here today with Linda Key, our founder and our Chief Training Officer. Linda,
Hello.
welcome.
Hello.
You know, in another live stream that we discussed here on the Pastor series, we covered three ends that was focused on moving taxable income to historical cash flow.
Right.
But honestly, as a lender, we don't lend on historical cash flow. You and I have had that conversation many a times. We need to project cash flow. So in this session, we're actually going to talk about the other three ends that kind of gets us the focus of projecting forward and will we get paid. Linda?
I do like that we split it up though, because the time that I like historical cash flow is if I'm doing entity level historical analysis. What was their debt coverage ratio this year? What was it this year? What was it this year? How have they been doing? And now project. So I don't at all object to getting to historical and pausing there to do some work, but for purposes of the next loan or extending the loan we've got, that's we got to get to projected. So the first one is non-recurring items. And as we did in the other live stream, I'm going to do the 1040 examples first because I think that they're the easiest to understand, and then we'll see how it rolls into the pass-through entities. So in a 1040, non-recurring items could be almost anything. So I'll just give you a laundry list. Maybe they no longer have a job, so their wages are non-recurring. Maybe they've sold a rental property. They are gone. Maybe they've received the last payment on a note or contract receivable. If they have capital gains on the sale of a house, probably unlikely to repeat it every single year unless they are actually real estate investors, which I am. I never did actually do it every year. And mostly I kept more than I sold, which is, really nice now, got to say. And then if they had a Schedule C, there may be a business insurance settlement, a lawsuit settlement or something that is unusual for them. Or on the expenses side, maybe a bad debt write-off, maybe flood repairs from something that was unusual. So you can see that almost anything that's on the 1040 might be non-recurring, which is why we get at least 2 years and most often 3 years, and we kind of compare them. So we notice them either because we have compared or because they just look odd for that kind of a business. In my view, no difference with the pass-throughs, really. Anything that's in there could be. So you're going to find non-recurring items in pass-through entities by comparing the front page of this one to the last year's front page, especially if total revenues seem real different or total expenses seem real different. Let's drill down and find out which ones have changed a bunch to decide whether there's something we need to know a little bit better. Now, if you're doing historical analysis, we left non-recurring items in because they really did have that income or incur that expense. But if you are projecting, we need to spot them. We need to take them out of our numbers. We need to document our thinking. And if you don't even mention you looked, then the examiner or your boss or whoever else is above you will look at that and go, you didn't even notice the bad debt expense, right? Didn't even notice the repairs. So if I notice it, but then decide it is recurring, I still might make a note in my documentation so that people know, yes, I saw it, but I thought that it was reasonable to leave it in. So there's our non-recurring. David, what's next?
Right, this is kind of a unique one, and this is the one when I first got into the training, kind of was interesting to think about is this isn't even on the tax return. These are like new income, new expenses, a new organization. It hasn't made it to the tax return. So when we're talking about projecting forward, and I work with a lot of clients when we're talking about projections because they're either going to add new pieces of equipment, they're going to go into new markets, they're either going to expand their business, they're going to acquire a business. All that stuff is not on a tax return yet, so we need to project forward as to what it may be. So it's never there. Now, where might we find this? From a 1040 perspective, it might be just on the regular application. We might ask the client something if there's going to get additional income, or if we know that a new job is going to be coming, or if we know that They're going to maybe buy some rental properties. We may consider that as new into the income. Possibly we could look at it from year to year financial statements. We may see some evolution as far as it going forward. So we will project their growth, maybe increasing 10%, 20%, because we know that there are new markets. So we might want to make an adjustment from that. Maybe you just learn from your ongoing conversations with your client. We want to make sure we converse with our client, know what's going on in their business, because sometimes these new items are worthwhile to understand from income. With regards to the expense side, it's interesting now that if you're going to be expanding, you might be having new employees, you might be having additional expenses. Hence, the new income sometimes comes with new debt, new type of obligations that we need to be aware of. So anything new to the picture should be concerning.
Hey, David, as usual, you said something that made me think, and now I'm going to talk about what I just thought of. The difference between projection and forecasting is interesting, because projecting might be, well, they already do have a new rental. They just got it since the tax return year. So I really do have rental leases to look at, as opposed to, and also very relevant, you were just talking a little bit about forecasting. They are expanding. So how are we guessing what will happen to their expenses in the expansion? Two different things. We, as a lender, we need to understand how to handle both of those. So when I have when I have a new income, but it's new to the tax return, but it's not new to them because it does exist right now. They own the rental, they're getting alimony, whatever. Then I do have something I can document, I can ask for documentation for. When instead, and as important, I realize, oh, they are actually expanding. Now I need to move into, well, how could I assess their forecasts for that expansion? What are they thinking? Where are they getting their ideas? Have they successfully expanded before, right? So we almost have three different kinds of things. It's almost another N that I don't really have a name for, because it's still new income, but there's new income they already have, just didn't in the tax return year. And then there's new income that's coming that we need to think through in a different way.
It's a great point. I never really reflected upon that from the projections. I deal a lot with forecasting when we're dealing with acquisitions, and then we get into the whole conversation as to some assumptions, how they base that. But you're so right. If we know that something is in line, whether you're dealing with rental properties, or quite honestly, even if it's an existing business that is forecasting growth, but they've had a steady plan of 3%, 5%, we probably could project that additional 5% into the next year and feel comfortable with that, because we have some track record that we can feel comfortable with, versus if I'm expanding into a business, now all of a sudden I'm taking sales to a totally different level and expenses, and we'd want to document at least our reasoning, and if we feel comfortable if this is the investment that we want to participate with.
So it sounds like forecasting is another live stream.
Yes. Yes.
All righty. So let's see, where are we?
Okay, we talked about, now what about non-documented income? That's an N.
There's our next N. And this is the last one, and it doesn't apply to all of you. So non-documented is income I'm not including because I have not bothered to get the documentation. Some of you are thinking, why? Why would you not? Well, in mortgage lending and consumer lending, it's not uncommon that if we can get them qualified with maybe just their wages or their business income or whatever, that we don't also have to get all the details on alimony or child support or consider even the capital gains from their stock sales. It's like once we can get to yes confidently, then for consumer mortgage lenders, they're allowed to full stop. Not true generally with your business and your ag lenders, because you folks are intending to loan over and over, right, to that entity. And so you want a full picture every year. It could be, though, business and ag lenders might come in with you. If you have a very strong entity, it can stand on its own. Yes, you're getting a guarantor because you're required to, truly not counting on their additional income. then maybe with the guarantor, you're not going after all the alimony and the child support and, ad nauseum. You're really relying on the entity. So non-documented just means that because of your guidelines allowing you not to go 100% to everything they possibly could have, because you don't need it to qualify. If that's true, then we don't get to count the income that we didn't document. So that is the last one for that, I think. And with regards to the ag lenders maybe not needing to do it with the guarantors, David, this takes us back to our very favorite answers. And that is with all three of these. When I say, do we need it? Do we not need it? Do we count it? Do we not count it? Especially with that third one, non-documented. The two answers are, it depends. And David?
Check your guidelines.
Check your guidelines. All righty.
Oh, what a conversation. There you have it. Our K-1 Pass-Through Entity series. It's filled with conversations that we focus on many questions from you, our followers, as you encounter these confusing issues, especially when you're dealing with pass-through entities. As a reminder, we always love to hear your comments. We'd love to hear your questions, as similar to what we received today. So feel free to contact us at our experts at Lenders Online Training, or check out our website at lendersonlinetraining.com/ask the experts, because Lynn and I will answer your questions. So
we answer them every time, David. We always do. And here's what's fun. We answer every time, and then sometimes those become a live stream topic, or this Ask the Experts is actually a weekly email. Those come from the questions you ask. We do answer your question. And then if we think it would be helpful, we put it up on a blog post. We do that once a week. And the people that are on that email list simply get an email. The subject line is the question we're answering. And you can go, oh, yeah, I need to know that. Read it. It's a quick blog post. Or my team needs to know it. Or no, I've got that. I'm fine. You can, of course, unsubscribe from that. That is a subscription list. But these are two ways, the live streams and as also the Ask the Expert emails, where we call it the drip method of learning. You just learn a piece along the way once you have the basics. Of course, if you or any of your team need the basics, you know where to come, lendersonlinetraining.com, where we absolutely help lending and credit professionals say yes to good loans. Thanks, everybody.
I know.